Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And we've been working our way through a pretty difficult market environment for bullish strategies such as the ones that we cover in this series. But sometimes there can be a lot of learning that can be done in reviewing the trades that have kind of gone south on us. So today we're going to be taking a little extra time walking back through some current positions that are not doing so well right now, but then learning some important lessons for maybe planning how a covered call might be applied to a trade that's struggling a little bit. Should be a really good discussion. I'm really looking forward to this one. But before we can get to any of that, though, let me first of all say hello to everybody that's already chatting in out there in YouTube land. Hello there, Jerry and Kevin, Selva, Ranbir, Eva, Chris, Scott, Lawrence, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation. Be aware that you're invited to join us in the live discussion. If you'd like to be here, we kick things off promptly 2 Eastern, and this is a Monday webcast series. We'd love to have you here in the live stream audience. And also as a special treat for my live stream audience, we have my very good friend Barb Armstrong. She's going to be hanging out in the chats, addressing any questions that I can't get to as long as they're in keeping with the theme of the presentation. Barb's there to help pick up the slack for me. Thanks for being there, Barb. And Barb and I would also like to issue an invitation to everybody watching. If you have an account with X, you should be following your favorite presenters there on X. It's another great resource, best place to connect with your favorite presenters. And you can find Barb there at Barb Armstrong CS. I noted Eva was complimenting Barb on her great X post. I'd agree with that. Also, you can find me on X at Cameron May CS. But with that said, let's get into this discussion. And of course, the first thing that we always need to do is to consider the risks associated with trading. It certainly applies to options strategies, which these are. So keep this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so with that, let's set an agenda for today's discussion. I'm going to mix up the order of things a little bit here. What we're going to do to set the stage for today's discussion is take a look at what's going on with the markets. Now, we're going to be doing a covered call, management of covered call positions in this discussion. And as a covered call trader, a couple of markets that we might want to keep an eye on, the stock market and also the options market. So we're going to take a look at those two first. Then we're going to get to our existing positions and look through all 7 of those. But there are 3 that I think we need to give special attention to today, and those are going to set the stage for actually adding some new positions to our portfolio. What we're actually going to be doing is selling covered calls against stock positions that we already own in the portfolio. But I think there's going to be some interesting insight into which strikes are selected. Maybe a little bit counterintuitive for some of you watching. We certainly want to weigh the pros and the cons of what we're doing as we're adding those covered calls. So this should be a good discussion, but really the emphasis is going to be on learning from trades that have been struggling and how that may actually cause the trader to make some different decisions in the management of those trades. So let's go to the Thinkorswim desktop platform. Here's the S&P 500. So as I mentioned, if we're talking about covered calls, well, covered call is a 2-part strategy. Buy some stock and then sell a contract against that share position. So since the trader is participating in both the stock market and the options market, maybe we want to take a moment to get context of both of those markets. So using the S&P as sort of the stand-in for what's going on with the stock market, here's what's been interesting recently to some traders. They've noted since we hit this February 19th high, sold off hard. Now, one thing that has happened over the last couple of weeks is that we broke this longer-term upward sloping trend line. broke through that. We also broke through a shorter term area of potential support. I actually tweeted, or let's say it's a post on X, about this possible emerging double bottom. We never confirmed it as a double bottom. It didn't get back up above these highs. Instead, broke down below those lows. So we have broken horizontal support. We have broken diagonal support. And then that's dropped us down to a potentially important and a potentially interesting new level for stock traders. Now, one thing about this level, let me go to a longer term chart here. Let's bring up a 3-year chart. And you'll notice the first trend line that we broke actually connected across lows through all of last year and through the highs of the year before that. Now, as we broke through this support, that took us down to possibly another trend line, which are the lows of the trailing 2 years. And it might be technically interesting to some that we've dropped down, touched off of those, and then started a recovery. Now, what this may signal, though, it might be, could it be possible that stocks start to trade in a channel like they were back here for the better part, well, actually for about 12 months right here. So once we popped out of that channel, we traded higher. Could we just be resuming a new channel? Maybe leading to a slower recovery. Time will tell. But that's going to be the start of a technical premise for our discussion today. But going back to our daily chart, one other thing that I did want to point out, I've done this a couple of times in recent webcasts, is there's something interesting about the proportions of this sell-off right here. And to measure this, we're going to come down and use our Fibonacci retracements tool. I'm going to click on the little percentage icon and draw from the lows of just a week ago up to the highs of February 19th. And quite commonly for traders who use Fibonacci analysis in the examination of charts, they pay attention to these sorts of proportions. When we get a strong move in one direction or the other, there's a common assumption that there should be a rebound in the opposite direction. So in this case, we had a strong move down. Well, the rebound event taking us back up may take us right back up about 50% of the distance that was originally traveled downward. So it's kind of interesting that there's our 50% fib that's also coinciding pretty neatly with the lows right here, and it's also intersecting with our trend line. So let's say, and this is not the only way, this is not the way that every single trader is going to see things, but let's just say that our hypothetical investor out there who's managing their portfolio of covered calls and short puts are trying to make the best decisions they can on the evidence that they have. They see that it looks like we might have a near-term ceiling where stocks might struggle to get above that level. Well, that's actually a time when some traders will look to add a covered call income position to existing stock positions. Because if they don't think their stocks are likely to go higher, maybe that's time to recruit an income element. Now, over the longer term, maybe our trader thinks that we're just going to swing down into this channel and maybe start into a nice upward trend after that, but at lower levels, at least initially, than we saw before. But we're going to use this as a premise. Let's say that this is our technical outlook. Now, obviously, a trader might decide, if we're going down for a month, maybe I ought to just go sell my stocks. Some might choose to do that. Others, though, might say, well, ebbs and flows are just the nature of the marketplace. And maybe instead of jumping ship every time I think the stocks might turn and head down for a little while, maybe that's the time to sell a call. So that's going to be our premise here. We're going to be adding some calls to existing positions for out here for that May 16th expiration. All right. But that's what's going on with the stock market. What's the scenario for our options traders out there? Let me throw out a quick question to everybody watching now. If you feel comfortable with the volatility index of the S&P 500 charted under the symbol the VIX, VIX, would you classify today's market as more of a market for sellers or selling options, or more of a market for buyers, buying options? Is it more of a seller's market or more of a buyer's market from an options perspective? Go ahead and chat that in. But I'm going to bring up our volatility index of the S&P 500 If you're not familiar with this index, it literally is what it's labeled to be. It's a chart of 30-day expectations for volatility on the S&P 500. And typically, when volatility is high, options tend to be more pricey. When volatility is low, options tend to be less pricey. So high and falling VIX is commonly seen as a seller's market for options. Low and rising VIX is commonly seen as a buyer's market for options. And so Kurt is saying it's kind of a seller's market. Vic says selling options, and Greg says sell. Yeah. Now, I think as we look at this chart, you can see that we've recently hit peaks, so we've only hit once in the last 12 months, and we've been pulling down in anticipated volatility from those levels. And so in my mind, in the trader's mind, that actually sort of paints a picture for what's going on with premiums largely across the spectrum of U.S. stocks. Options prices are likely falling across a bunch of stocks. So if that continues, and if let's say we sell now and options prices continue to fall, well, falling prices is typically what a seller wants after a position is taken. So if we're looking out here to May 16th and our trader expects things to go lower, yeah, that is a pretty good description of a seller's market. Could it though? Could we see a return of volatility? Could we see a spike right back up if something unsettles the markets again? We certainly could. But there's our context for the stock market, the S&P 500, and the options market. Looks like it might be more of a seller's market for options. Both of those lining up kind of nicely for someone who maybe already holds stock positions and they're thinking about selling options as potential income on those positions. So just park that in our minds for now. I want to go have a look at what's going on with our existing positions. Let's go to our monitor tab. Here are our covered calls and short puts. Yep, they are underwater mostly struggling, not surprising. These are bullish strategies and the markets have not been bullish. Doing okay today with the rally that we've seen, even though we're fading, we're still above yesterday, or we're still above Friday's close. So overall, our positions have actually regained about $2,000 of the $4,000. Well, it was $6,000 on Friday that we were down. Now we're down $4,000 across all 7 of our positions. So let's go through these. Now, let me tell you how we're going to go through these. Apple, IBM, and Wells Fargo are actually just stock positions. What is this? This is not a webcast called Trading Stocks. This is covered calls and short puts. Well, actually, these were either previously a covered call position or a short put position. So those ones are going to be the ones that we focus on managing today. We're going to be adding some covered calls to those stock positions. So let's talk about the other positions first, our Meta, our NEE, Tesla, and Visa. So what's going on with Meta? Meta, we sold 25th of April, 510 put. So with this, we'd like the stock to be above 510, and it is. It's at 533. Here's what's going on with our Meta trade. And with each of these, I've sort of mapped out the trade. Now, some people, I've had this question a couple of times come in on the YouTube comments. It's a fair question. Somebody will say, why don't you just do this on what's called the Analyze tab on our risk profile tool? Can't you show profit and loss potential on that? Yes, I can. But I like to add the notes here. I like the kind of green and red color schemes. Plus, I also like to include a history of trades that we've done that are still related to the current position, but that have been closed up. So yeah, I do prefer to just map it all out here on the chart, but it's not the only way to do this stuff. In any case, here's that 25th of April, 510 put. We sold that to expire before this earnings announcement, so that's not a threat to come in and mess things up right toward the end. But we entered our trade right here, bullish trade. We'd like to be above 510, which is our red line right here. We actually dropped below that temporarily, but we've popped back up, and we're still above 510, although lower right now than we were at the start of this trade, so we're still underwater, but we are in position. we're right where we'd like to be in position for our theoretical maximum gain. If we can just sort of stay where we are right now, if we go up, that's great. If we come down, it's not too far. We're in good position. So this one, I'm going to leave that one alone. All right, we have a break-even point right down here at 504.30. That's 510 minus the credit that was received for that short put. So on to our next trade. We have Nextera, sold 2 contracts of the 72.5 puts for the 17th of April. That's coming right up. It's only 3 days away. We won't have another chance to talk about this trade until next week after expiration. Now notice these little key letters right here, ITM. This is Thinkorswim saying, Cameron, your puts are in the money. Might need to decide what you want to do with these. So let's go look at this on a chart. Yeah, if you see that ITM, it means we're getting close to expiration and the contract has gone in the money. So here's where we initiated our trade, sold the 72.5 puts for $1.56. We'd like to be up here. Somewhere above our break-even point would be nice. However, we've discussed in the past, sometimes we get assigned on these puts, and for some traders, they're totally fine with that, because assignment with a short put means someone sells us shares at the agreed upon price. In this case, that would be 72.5. But in any case, if we're assigned, we're now shareholders, and we could possibly go sell covered calls against that position. So we've fallen below our break-even point. We've been making our way. Could we get back up above break-even by expiration? Yeah, we could. It's unlikely at this point. Only 3 days left. Although, you know, if we got one of these days, that could shoot us right back up to break even. Could even get us back out of the money where assignment isn't likely. What I do want to say here is we have a luxury with these existing positions in a paper money portfolio. Early assignment's just not a threat. It doesn't ever happen in paper money. That's very different from real life. It can certainly happen in real life. So there's an important distinction. So I can kind of confidently say, well, we're not going to put the shares before, 3 days from now, before Friday. That's because, yeah, it's paper money. So what might the trader do here? If we just leave this alone at any time from now until expiration, if we're still below 72.5, we might get assigned those shares. We could decide to go buy the puts back. They're going to be expensive to do that. That would be realizing a loss, but then there's no additional exposure to risk. Or the trader might say, that's okay. Sell us the shares at 72.5. We're going to be a little bit below break even at that point, but then we can start selling calls, maybe regain things if we are bullish from here. That's what we're going to do with this trade. I'm going to leave that one alone. Next up is Tesla, which is actually doing just fine. Tesla is a covered call where we bought the shares at 233. The shares are now at 249, so the shares are doing fine. We sold a 280 call for 249. The stock is well below 280, and we only have 3 days sale expiration, so those calls are now only worth 62 cents. But if we want to see this on a chart, here's what's going on with Tesla. So bought the shares, 233.07. Stock went up, sold the 280 calls. We're just hoping to stay below that for just a few more days, and that's right where we find ourselves, above our purchase price for the stock, below the calls that we sold. That looks okay. That one we're going to leave alone. Next up is Visa, which is another short put. Sold the 330 puts. It's a bullish strategy where we'd like to be above 330, and we're at 336 right now. So this one's also doing okay. If we go look at Visa, it wasn't initially doing okay. We saw a possible bull flag right here. So we entered a trade, but we faded and then recovered, and we're above our strike. We're out of the money. The assignment risk is lower. It's not eliminated. It's still possible. But as long as we're above that 330 for just a few more days, most likely we just realize the gain on the 257 credit. Break even, if you want to track that, is credit received 257 subtracted from our obligation to possibly have to buy the shares at 330. So our break even is down there at 327.43. So those are positions that we're not going to do anything with today. But the other ones, yep, we're going to be adding to these What I'm not going to be doing, I usually manage existing positions, then I go find something else. I want to dedicate our time to just the management of these trades because I think there are some lessons and some sort of not terribly intuitive takeaways from the way that our trades have behaved up till now, and the strike selection process for the new covered calls we're going to be adding. But let's look at our Apple. Apple has a history with us. We've actually done a few things with this. So the initial trade was taken back here when Apple looked more bullish. This blue oval is when we first sold a put at 235, and obviously a trader here is hoping for the stock to be above 235 as we move toward expiration. Well, this was for the 21st of March. That's this expiration right here. And if we look at that on the 21st of March, we were not above 235. We'd actually fallen below, so we were assigned the shares at 235, which did mean at that point we realized the gain on the put. So at that point we had 235 that we paid for the shares, but a $3 realized gain on a short put. So our break even was at 232. Then we sold some 17th of April calls. We owned the shares at 235, sold some shares with the stock down here, sold 17th of April contracts up here, and we actually closed these out last week because the stock just continued on its merry way downward. Ouch. Big drop. Now, what we might have chosen to do last week is to bail, get out. Had we done that, that would have been painful. So this is where we had a discussion last week, April 7th. Could have sold shares. That exit would have been 180 bucks, maybe lower. We had to buy the shares for 235. If we sell them way down here, we'd be sitting on a big loss. Well, it's been in recovery mode since then. Now, last week, what we did choose to do is just close out of the calls that had really collapsed in value. We were able to realize an additional 80-cent profit. Those 17-cent calls, those 17th of April calls that we sold them for 88 cents. Just a few days later, we closed them out for 8 cents. So we now have 2 realized gains on short options, $3.80 of total credit collected. So that's lowered our break even down to $231.20 for the shares that we paid $235 for. We're still below that, but making our way there. Okay. Vic says in a money account, there are good chances of getting assigned. Should one take the profits and close these trades? That's a good question, Vic. Yeah, with their pros and cons to holding on to the position so you're kind of going back to Tesla and Visa, right? The Tesla trade still out of the money. But do I want to go back and revisit that? I think that's okay. Let's go take a quick peek because Vic, it's an appropriate question. We're sitting on profits right here. Could the trader decide with that Tesla? And I thought about it. We sold those calls for $249. It might cost us only about 65 cents to close those out right now. That would be realizing a gain of about $1.85, about 75% of the maximum amount that we could possibly make on this. Now, that leaves about 63, 65 cents on the table on 3 contracts. That's about $200. But it also, if we decide to get out, it removes this upside limit to how much money we can make on the stock. So it's up to the trader. Is it worth paying 63, 64, 65 cents to get rid of that obligation? Yeah, it's up to the trader. So I'm just going to leave it with that Tesla. I'm not going to go back and have a look at Visa again there, Vic, but just be aware that what we need to do is just weigh the pros and the cons of each decision and just make the best decision the trader can make. Okay? But back to our Apple trade. This is what's so interesting about this. Couple of lessons when things, first of all, if we own shares and the stock has collapsed in value, it can be tempting to just have sort of a reflexive reaction. Smack the panic button, get out. Now, I think that there are plenty of people out there that are doing just that. I think it's also possible Apple could have kept selling, and selling last week could have been the best thing to do, but we didn't do that. But quite commonly, when there is a very strong move in one direction, maybe that's sometimes the worst time to sell. So even though we wish we could go back and change history and say, I wish I didn't buy the shares up here. Sorry. Fact is, we owned the shares and we have to decide what to do with the current situation. Now, here's another thing. I wanted to talk about, and this is going to be a theme through the rest of our discussion, which strike prices to sell with covered calls, because here's what a trader in this scenario might be confronted with. How much did we have to pay for these shares? We paid $235. We were assigned the shares at $235. If we go back here and you look at the trade price, there it is. We paid $235 for those shares. For some traders, they absolutely draw a hard and fast line. They say, I am not going to sell a covered call that obligates me to sell my shares for less than I paid for those shares. So at the very least, the trader here's where our stock is. Here's what we paid for those shares. Let's say they were planning a trade out here for May, recognizing, yes, there's an earnings announcement. I know that that's there. I'm still going to go ahead with trades anyway. But for some traders, they would insist, I need to sell at the 235 strike at the lowest, because that is an obligation to maybe have to sell the shares. And at least at that point, I'm breaking even on my share trade. Bought the shares for 235, and if I have to sell it according to the terms of the contract, I'm again selling for 235. That's a break even on the stock. Here's a different way to look at this. Am I saying it is the only way to look at it? No. What about this? Yeah, we paid through 235 for those shares, but along the way, we've also realized some gains on some options trades. So really, to break even on this sequence of trades, we don't need to be able to sell the shares for 235. What if we could sell those shares for less than that? I want to look at, for this one, 230. Ooh, why 230? That's even below our break-even point. Let me go to the trade tab. Let's go to the 16th of May. So we're on Apple. Let's go to the 16th of May contracts. And I want to look at that 230 call. That looks like that's trading between 186 and 188. Let's assume that we do that. Let's say we're able to sell this for $1.87. All right, let's go to our charts. I'm just going to assume we do that. Let's draw in a line at 230. So there's 230 right there. Let's intersect that with today, so that we're sort of seeing where our trade is starting and where it's ending. I'm going to click right there and move over here. That's going to represent our strike price. Bought the shares at 235. Why in the world would I agree to sell those? Let's make this one red, indicating that we're selling. Red doesn't mean bad, it just means short. And just to be precise, I'm going to right click on this and edit the properties of that drawing. Let's put it right at 230. To start, right at 230 to end. There we go. Here's the deal. Let's assume, what did I say we get, $1.87 for this? Let's put in a text note right here. Sold the, what is that, the 16th of May, 230 call for, let's assume $1.87. Let's assume that we're able to retrieve that credit here. Well, if we get $1.87 for that call, what does that do to our break-even point? Right now, we've realized gains of $3.80. This gives us an additional potential gain of $1.87. That would take our $231.20 break-even point, $231.20, subtract $1.87 from that, and we would have a break-even down at $229.33. Interesting. So if we did this trade right now with our stock down here, let's talk through the ceiling that we put on our potential for profit. if our stock rockets up by May 16th, if it goes up here to 235, 240, 245, 250, let's just say whatever the circumstances are, we ultimately are required to sell our shares for 230, hey, we'd lose $5 per share on our stock, right? Bought the stock for 235, sold it for 230. We're drowning. We lost money. Yes, but that would mean that we realized the $1.87, that's a new profit on our call, plus 80 cents that we've already realized, plus 380 that we've already realized. Let's do the math on that. $1.87 plus the 380 already realized. That would be $5.67 of gain on our options. So are we really putting ourselves in a scenario where there's no chance for making money, where we're just admitting defeat? No. Okay, so that's sort of a different way to look at these, where I think for some traders, they focus on, am I buying or selling am I selling the stock at a loss? And that's the only thing we focus on. Well, remember, we also have the credits received from our options to consider. Now, Vic says it's almost break even. Yeah, almost, but actually slightly profitable. We lose $5 on the stock, make $5.67 on the options. We profited, not enormously, but is making a 67-cent profit after what we've been through over the last couple of months. Does that feel like a victory? It can. All right, John says, oh, you're talking to Barb. That's okay. I'll let you continue that back and forth. John says, in order for a trader to not lose money on a put, the seller would have to know the direction, the extent of the option would go. You don't have to know it. It just has to behave. A put, when we sell a put, it's a bullish strategy. So we prefer for the stock to go up. Yeah. So we try to make our best guess. We can't ever know for sure, but we can do our best to gauge, what we think of current economic conditions, what we think of the chart scenario, and then just risk is still there. Yep. Steve says, question, so there's nothing really wrong with selling options right before or through earnings as long as you manage it, right? Well, some traders, Steve, nothing inherently wrong with it. That's probably an accurate statement, as long as we understand the pros and the cons of what we're getting into. For some traders, they may say, why am I going to put a cap on my potential for profit at all? With an earnings around the corner, if this earnings goes extremely well, Apple could just shoot up, and I don't want to have to sell it to somebody else. So they may choose not to do the call. That's fine. Well, if it shoots down, though, that's another possibility, or just go sideways. But in any case, if the stock isn't behaving bullishly, then the incomes start to feel kind of nice. Yeah, that's the sort of trade-off. So there's not a right or wrong way to do this. As always, there are pros and cons to the trade that the trader is planning. And you just do your best, you place your trade, and then the markets are going to do what the markets are going to do after that. All right, but I'm going to do this. Let's assume that we sell this call. I'll come back here and edit this after we've sold it. Let's go back to our trade tab. Look at that 230. Looks like we might be able to get a little bit more for this, a few pennies more. But we just have the 100 shares, right? So let's just sell the one contract at that 230 strike. I just wanted to have that discussion for why it can feel illogical sometimes when we're taking upon ourselves an obligation to maybe have to sell the shares for less than the worth. Why in the world would we ever do that? That's sort of the logic of it. John says, Cameron, isn't it easier to make money selling calls and puts than buying calls and puts, even though you wouldn't make as much money per sale? John, it's not easier. Nope. Because that's sort of implying that one strategy is better than the other, or more. What I can say is selling is higher probability than buying, but buying carries way more profit potential per trade. Now, whether profits are actually realized or not, that's up to what happens with the stock and with volatility and with time after the trade is placed. But there are pros and cons. So some traders prefer the high probability, lower reward scenario, typical of selling, and specifically out of the money options. Other traders are actually totally fine with the lower probability, but enormous reward potential of buying. So there we go. All right. We're going to sell this one, 230 call. Yeah, I said 187. How about we just say we're okay. We'll settle for 187. If there's more available, we might receive more, but we're submitting this as a limit order. Let's see if we can get it filled. I just saw the price tick down a little bit. So we're going to sell this one call at the 230 strike, try to get $1.87 for it. It doesn't have infinite max loss because this is a covered call position, but there is a commission to be considered here. So let's send this off and we'll let that work. So here's our working order. $1.87 is what oh, there it is. Filled. Okay, we got $1.88. That changes things just barely. Let's go back to our charts here though, and let's edit this one. Let's edit our text note. So it was $1.88 that we received. So that means $5.68 in total premium. So that would take our break even down to what would that be? $229.32. Yep. I'll adjust that after webcast. But yeah, $229.32. No, yeah, that's right. Let me right click on this also. We'll make that red, indicating we sold a call. All right, but there's a lesson. Let's go apply this lesson again. Let's get some repetition with this with our other positions. Apple, oh, by the way, so we sold the call. It's in our margin account. It's down here in the unallocated field. Let's right click on that now. And let's move that to our covered calls and short puts group. There we go. So now we can see up here, there's our Apple trade. Own 100 shares, sold a call. All right, IBM, pretty similar. Here's what's going on with IBM. We've collected a couple of premiums, realized some gains along the way. So far we've realized $4.71 in profits. Bought shares at $249.05. We've fallen below break even, but our break even's up there at $244.34. I wonder if we were to sell, let's see if we can sell like a $250. That could actually be above the price that we paid. Let's go ahead and do that. So this one, we're not going to agree to sell the shares for less than we paid for them. Let's go above what we paid for those. $250 looks like we collect $675, $715. We might even push that one higher. How about we go up to $260? That looks like that's trading between $330 and $375. There is an earnings announcement coming up. An adjustment that a trader might make is just sell a contract before that earnings. But I think with this one, we're going to sell a call. Yeah, let's sell it above what we paid for those shares. Go for $260. Again, we just have 100 shares, so let's do one contract. And that's trading between $340 and $355. Let's just try for $340. Submit that as a limit order here. All right, so there is a commission to be paid, but we're going to sell that 16th of May, 260 call, $3.40. Let's send that off. And while that's working, so we'll have an obligation to sell our shares up here at 260, purchase those at 249. So we have about $11 of upside. If this earnings announcement goes well, we could make maybe an $11 gain on our stock if we pop up, get called out, in addition to whatever we just sold that call for. What did we get it for it? Filled orders, sold that for $355. Okay. Now there's we have one other trade. We have time. Let's look at Wells Fargo. This is going to be just like Apple. First of all, let's move our IBM call here. Right click, move to group, covered calls and short puts. But our Wells trade, here's what's going on here. Bought some shares at $70. Those shares popped up. We sold some calls up here and realized a gain. Shares fell back. We sold some calls here, continued to fall. We realized a gain on those. So we now have $2.87 in realized profit. In addition to the $70 that we paid for our stock, that puts our break even at $67.13. if we were to try to sell up here at 70 bucks, we may not get much for those contracts. Let me look at the trade tab here. Going out to the 16th of May, $70 contracts, we're getting maybe 57, 60 cents. That's pretty close to 1%, actually. That's not terrible, but let's maybe look at selling the 67.5. This is, again, agreeing to sell the shares for less than they are worth, but it's going to be above our break-even point, and especially as we bring in more premium, it's going to lower that break-even point even further. So let's go see how much premium we might be able to get for that 67.5 call, about $1.22 to $1.25. How about we do that one? So that might lower our break-even. Let's say we get $1.22. That would take our break-even down close to 66. So even if we get called out at 67.5, that would be $1.50 above break-even. So let's do that one. 72.5 call. No, 67.5 call. Click on that bid price, selling that one contract at 67.5. Let's say, yeah, 119. Let's submit our limit order at that price. Click confirm and send. Trying to sell that 16th of May, 67.5 call. Trying to get $1.19 of additional credit for that. There is a commission to be paid here. Let's send that order off. There we go. We'll see if that fills. Looks like it's trading for 121. We're only asking 119. I feel pretty good about that. We're likely to fill that. And there it is, 123. Yeah, so guys, we just lowered that break even though we're below what we paid for our stock shares here. Our break even is now down below 66. So if we get called at 67.5, it's still a profitable trade. We'll see. Time will tell. But guys, I thought that there was an opportunity here to learn from some trades kind of gone south on us and how that might change. Just some might have this assumption that if we pay a certain amount for the stock, we should never agree to sell it for less than that. Maybe not. It's always up to the trader. But we've looked at the stock market and the options market. We got some context there. We examined our existing positions and we've added to those existing positions, but through I think a different lens, as we're including the credits that we've already received and realized along the way that may give a different outlook to selling covered calls. Everybody, I hope you enjoyed this discussion. If you do enjoy this topic, make sure that you're joining me each Monday. We do this every Monday. Talk about covered calls and short puts, but we do have other webcasts. So also do yourself a favor. Make sure if you haven't subscribed to our channel that you do that now. You can go down below the video stream and click on the subscribe button. But that subscribes you to our YouTube channel, and that's where we house our previous webcasts. So when you've subscribed, you can go to YouTube and search out Trader Talks Schwab Coaching Webcast. That's our full channel name. That's how you know you're in the right place. And right here on our homepage, you can find our playlist for our other YouTube series, series as the plural version of that. Anyway, you can find all of our previous webcasts here, with a few exceptions. There are a few webcasts that don't make it in the archives, but yeah, this is where you'd go to find those. You can also join the live streams right here. Also, do yourself a favor, make sure that if you have an account with X that you are following your favorite presenters there as well. You can follow Barb there at Barb Armstrong CS. And you can follow me on X at Cameron May CS. Let me show you that, because you do want to be precise. Make sure that this is how you spell my handle, at Cameron May CS. Don't want to wind up following someone that just has a similar handle. But yeah, that's the best place to connect with your favorite presenters in between these live streams. All right. Time for me to let you go. Next up is Liz Ann Live with Ben Watson. Go enjoy that. But Barb, thanks for helping out in chat. Also, thank you to everybody that's already clicked that thumbs up button. I can see, 143 people still watching. 40 people have already clicked the like button. That's always appreciated. That's the way to give your presenter an electronic slap on the back, some applause for the efforts. It also gives my webcast a boost in the YouTube algorithm. Every time you click that like button, It boosts us in the YouTube algorithm, gives us greater exposure on YouTube, and helps more people find these webcasts so they can learn lessons like this. Everybody, I will see you next Monday for another discussion of trading covered calls and short puts. I also have other webcasts throughout the week. This week, of course, Good Friday, we're not going to be doing our webcasts on that day, but I'll look for you in my other webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.